Hello, chart watchers, and welcome to this Thursday, December 13th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we are reversing off of earlier highs, but currently the Dow Jones Industrial Average up 47 points. The S&P 500 has moved into negative territory, down 3. The NASDAQ down 30, and the Russell 2000 down 12. Obviously, some poor relative performance in small caps. Talk about that in a bit. 10-year Treasury yield trying to bounce a little bit here. It is up another basis point, 2.91%. Volatility actually coming down a little, which I guess is good, but we're still elevated. We're above that key 16, 17 area, but at least with the market turning mostly negative, we are still seeing the volatility index remain in negative territory. Leading on the upside, though, are our more defensive sectors. Real estate, you can see still with a gain. Utilities performing well, trying to break out. Consumer staples performing well. On the downside, though, leading again to the downside, trying to break to new closing lows, the XLF, which, of course, is the financial ETF. And also take a look at transportation stocks. We have seen an overall bounce in the market off the lows from a couple of days ago. If you go back, you can see it on the Dow. You can see this on the S&P, the NASDAQ, not so much on the Russell 2000. But look at transports. Transports all the way back down at the lows that we saw just a few days ago. And transportation services continue a very, very steep decline. Another huge down day here, almost 10% on the day. Not looking good in the transportation services area. And Erin, while I was gone yesterday, first of all, thanks to you and Mary Ellen for stepping up yesterday while I traveled back from Seattle.
We had a great time.
Yeah, I mean, market looked good. I got on the plane and everything looked really good. And I got off the plane and it's like, what happened? Where did we stop? Oh, something happened to the market.
You left Seattle. That was the problem.
What was that?
You left Seattle.
Oh, maybe that was it.
I think so.
Yeah, the market drops on just about anything, so it could have been that. Could have been my trip. Anyhow, wow, I'm not liking this market right now. I'm sure we're all going to be talking about it in a little bit, but let's not talk about it.
Transportation, Dow theory. Yeah, we definitely don't want to see the failure we're seeing right now. So more ugliness.
If we get down and break down on the industrials along with transportation, that would not be good right now. Industrial still hanging in there, but transport's not looking very good. And I was looking at the components of the transports, and when you see airlines, one of the worst performing industry groups today, and crude oil has dropped from $77 a barrel down to $50. And all of a sudden, airlines have just completely faltered again after looking pretty good, maybe a week or two ago. It's just seems like it's one thing after another.
Yep, absolutely. But
you got any plans? What's that?
We'll keep everybody informed.
Yeah. You got any plans for the weekend?
Boy, I haven't even thought about it.
I know you got all your holiday shopping done, right?
Most of that, actually. I do need to wrap some gifts. So I think there is there are a few things I can do. I'm trying to remember, though. I feel like there was, our neighborhood is having an ugly sweater, ugly pajama party on Saturday night. So looking forward to that.
Wow. I'm sure I could rock both of those pretty well.
I'm sure you could.
What do we got going? We probably should get into this.
Yes. Let's get to the market again. All righty. Well, here's our upcoming schedule. So we've got Mary Ellen will be back tomorrow for What's Hot, What's Not. She'll be co-hosting while I'm doing my Decision Point show that afternoon. I'm going to be doing my workshop on building blocks of technical analysis. Tell your friends, the ones that always say, I can't what are those squiggly lines? I'm going to really make it very basic so we can introduce some of the people who watch the show that just don't quite the topics, Danielle Shea will be here from simplertrading.com. And then our RRG creator, Julius de Kempenaar, will be here as well next week. So looking forward to it. We've got a great week to finish and a great week coming up. All right. Bill Shelby is going to start us out with Get Shorty. We'll see what he has for us there. Our first symbol for the 10 and 10 is going to be GOGO, G-O-G-O. And we'll finish off with Under the Radar. So should be interesting to see what's out there. I'm curious what you have, Tom. But let's go ahead and do our technical news and headlines.
Yeah, and before I even get into that, I have to apologize. I didn't bring Bill in this morning. That's awful. It's awful of me. Bill Shelby, how are you doing this morning?
Good. How are you?
I am doing pretty darn well. It was great being out there with you guys last few days. Yeah. And I know you and I talked a little bit about the market, the fact the market's been so weak. And, I did a trading workshop last week on shorting strategies. And I know you're going to talk a little bit today. I teased everybody and told them when you came in, you were going to do some scans, some shorts, and how you can kind of, set that up and talk a little bit about shorting. So I know you got that coming up, which is pretty cool. Looking forward to that.
Yeah, it's great having you out here. It's good to see you.
Yeah, it's always good to get out, once or twice a year and just kind of get back to the mothership, do some stuff with everybody face to face. A lot easier and works really well. But hang around because we are going to come back to you. I know everybody wants to hear about how you can use stock charts and all the powerful tools here to increase your chances during a down market. So I know you'll have a lot for them on that. So we'll get back to you in about 15 minutes or so. All right. So key economic reports out this morning. Initial jobless claims 206,000 versus 228,000. That was good news because I think the last three reports came in much higher than expected. And then we missed on the non-farm payrolls last week. So that combination was not good. So it is good to see a better economic report. The problem I have, though, is that is not really translated into a whole lot of good news in terms of how the bond market has reacted. We are trading a little higher today on the yield, as you can see. We have bounced the last 3 days. But, look at the drop that we saw and then look at this bounce. It just doesn't seem like it has much, going for it. And the way I set this up today, I wanted to give you a little idea of what's been going on in the market, what happens sometimes when the Treasury yield continues to move down like this. Take a look when the Treasury yield was first dropping back in November here. It's pretty significant drop, almost 3.25 down to about 3%. And while that drop was occurring, as long as we held support, check out financials relative to the S&P 500. They were rising throughout that early part of November, even though rates were dropping. I think the overall bullishness was still intact. I mean, we hadn't lost any major support on the 10-year Treasury. You go down, you take a look at banks relative to the S&P, and they were actually rising. Look at the transports relative to the S&P. Transports were rising. So everything looked good on this pullback. But since we broke down, I think this is where things have really begun to change for me, because all of a sudden now money is rotating into treasuries. I would have expected money to rotate out of treasuries when we got down to this 3% level. Instead, it's moved down. And I know the talking heads not that long ago were saying, well, the reason that the market is so weak is that the yields have broken out. Well, look at this drop in yields and look, what's happened to the stock market as a result. The stock market doesn't like this. The bond market is telling us we have economic weakness ahead. And so here you've got the XLF relative to the S&P dropping. So not only has the market been dropping, but financials have been the worst area in the market as they continue to drop. Banks are dropping relative to the S&P 500. I never look to leadership from the banks. I don't expect the banks to ever be the group that leads the market, but you want the banks to go along for the ride because that's the credit source for all our businesses. When banks begin underperforming like this, it really makes me nervous because having audited banks, I know when things start to turn economically, banks start to get very conservative. They don't want to lend money. You almost have to, give up, maybe your firstborn or maybe a couple of children in order to try and get a bank to lend to you when things are starting to turn weak. And so when I start seeing this kind of relative performance in banks, it makes me a little nervous. And as we were just talking about top of the show, Erin mentioned the Dow theory. I mean, when you get transportation stocks dropping like this over 2 or 3 weeks and moving to new lows while the market's trying to bounce, just does not paint a very good picture. So the S&P 500 hasn't broken down yet. We're going to talk about that in just a second. But this is something I think we need to at least be watching as we move forward, whether or not the S&P can hold the key support level that I've talked about here on the show quite a bit. 2582 is the number I'm watching on the S&P. I believe if that goes, I think the impulsive selling could really kick it up a notch. And, we were talking a little bit before the show, thinking about what catalyst maybe could drive the market higher and kind of turn things. I think if we break down the S&P, maybe something like the, U.S.-China trade war, getting an agreement in place, I think that would create a bounce. But if we break down first, I'm not sure it wouldn't be just a final bounce before another move to the downside. But a lot of speculation there. I don't want to speculate too much. Sienna reported their earnings before the bell this morning. They beat on the top line, beat on the bottom line, and then they gave some pretty bullish forecasts for the next few years in terms of their growth. I think they're looking for an annual growth rate of about 20% over the next few years. Big gap up, trying to make the breakout. I don't like that black candle. If that holds, we might see a little pullback, maybe all the way back down to test gap support. But at least it did gap up with a nice report. TLRD, Tailored Brands, not so much. Here's a company that missed on revenues, beat on the bottom line, $1 versus 94. But again, the market doesn't worry about what you did in the last quarter. The market's much more concerned about what you're going to do. And they lowered their fourth quarter earnings per share guidance. So all of a sudden, I was looking at this stock earlier. This was on my strong earnings chart list earlier in the year. And this is what happens to a lot of companies. You get a stock that goes through a cycle. I'm going to go back even further. Let's go back a couple years here. But a stock goes through a cycle. You can see the beautiful move up. Everything looks really good. And then all of a sudden, they start to disappoint. The growth isn't there anymore. And then they're right back down again. The Apples of the world that have gone up for years and years and years, those are the exceptions. Many of these stocks go through cycles where they perform well, and then they come right back down. And so unless you're in those larger companies or even smaller companies that can continue to, they're creative, they can continue to lead and innovate, those types of companies. But it's really hard to identify which of the younger ones are going to continue doing it for a long period of time. So that was TLRD. Let's take a look. I'm going to go through a couple of these indices for you. Let me just start with the S&P 500. Because on this chart, here's the low down here, 2582. We just hit 2583. The more and more times you go down and hit a support level, the less I feel good about it. I like double bottoms, maybe triple bottoms, but next time down will be about the fourth time. And eventually that support's going to give way. And if it does, with everything else breaking down around us, I'm not feeling very good about this. Let's take a look at a couple of, here's an index, the Distillers and Vintners, which were in a nice uptrend, sideways consolidated for a while. See how this low over here in February was held in August? But look what happened once it broke. You do get a rally back. You test the area of the breakdown. This is a head and shoulder, by the way. But you go back, you hit the neckline in the 20-day, and you move to another low. You go back up, test the 20-day, and you move to another low. This is the type of behavior we could be in for if we break down on the S&P 500. So I remember talking not too long ago about this group. When we broke below this 435, 440 area, I was no longer bullish the group, and I continue to be somewhat bearish. Well, continue to be bearish, period. This particular group, Distillers and Vintners. Let's take a look at a few others. This is the drug retailers. I'm going to shorten this back to a year. Nice uptrend that we're in here, but the last high, lower PPO. So we go back down, we test the prior support. We're back at the 50-day. We got the PPO back to the center line. This is an area where we could see a bounce in this group. Let's take a look at sodas, the soft drinks. I think it looks very similar to the chart just looked at. The retailers, higher prices, lower PPO, moving back down. I think the 50-day could come into play. PPO center line. Look what happened last time. Look at this move up. Last final high. Look at the PPO. What happens? We went down to the 20, had a little bounce, ended up going back down and resetting near the center line before deciding which way to go. At that point, it was going lower. Let's take a look at another one. How about DJUSFD, another industry group in the defensive area? Food retailers and wholesalers. Lots of bottoms here, right around 410. Look at that false breakdown. That's what I look for a possible reversal. When you go back down below key support and you hold it, you come back up, close above it. I think in that case, it's probably a decent indication you've got market makers on the long side in the group building inventory, and usually that'll result at least a day or two of strength, and we saw that with this group. I mentioned the transports earlier. I don't want to take too much time here, but as we look at the transports, look at this breakdown. We are now below this prior low. I do not think this is good at all. This is one of my biggest warning signs right now. No reason for the transportation average to do this and to break down below these prior lows. My gut feeling is it's going to drag the S&P 500 right behind it. Within the group, though, the railroads, which had been holding up so well for so long, they are back down and not too far from breaking down below the October low, almost back to where they were a few days ago at the low. And this was used to be one of the strongest areas of the market. Transportation services, just want to pull up one stock in that group, XPO Logistics. At some point, we're going to look at the volume picking up. This is one that's probably going to have a capitulatory bottom at some point. This was a $116 stock 2 months ago, a little over 2 months ago. It's now in the 40s. Think about what logistics companies do. They deliver goods. These companies, the transportation services and all these transportation stocks, individual companies like this falling so fast, I don't know. It's telling me that things are really changing. If you remember, one last comment, the Fed, Jerome Powell, just a month or two ago, said that we weren't near neutral yet. And then after all this hits, he comes out and he says, well, we're getting pretty close to neutral. Maybe just one more hike and then we'll see where we're at. That was a pretty big change in just a month from his conversation. But anyway, Erin, I know you got some upgrades, downgrades, and we want to get to Bill. So what you got for today?
All right, let's get to it right now. Well, our first one is going to be interesting. GE today was upgraded. It was upgraded by JP Morgan, and I know you had a little bit of a story behind that, Tom.
Well, yeah, the analyst that upgraded it to neutral has been pretty bearish on the stock for the last 2 years. He's a noted analyst that has been very bearish GE, and he simply came out and said, I think the bottom is near. And so we were kind of talking about it, and I honestly, I don't think the stock will go down more than about $7.5 from here. What do you think?
Yeah, I don't. I mean, yeah, we could get a little bit of a bottom. I could see consolidation. I mean, look at what we did from April to September. Big time trading range, and now we've moved all the way down here to that $7 range. I would probably look for a little bit more sideways move. I mean, the PMO looks pretty good, but internal strength, relative strength, is in the basement still. So I don't know. I wouldn't go out on that limb. But he upgraded it to a neutral, so it's not like saying yes, go out and buy it. But still, that was really interesting to see. Procter & Gamble was upgraded today by B of A Merrill from a neutral to a buy. I thought this one looked a lot better. Of course, it's in that consumer staples area, and we're getting a really nice breakout on it right now today. You can see we've had some high volume for a while. I think that, maybe this one could have been in under the radar. We've been moving sideways and even a little bit lower here, but picking up some really nice positive volume. And look at already for today, we're already above the last 3 days in positive volume. So I think PG, Procter & Gamble, looks pretty good right now. Well, let's go ahead. I'm going to move to the downgrades. Autodesk was downgraded today. Went from an overweight to a neutral by JP Morgan. And, the PMO momentum is starting to slow and turn around. I mean, I think it probably was a good call. One of the things I want to point out is, we had this big decline. We went into a nice bullish pattern, double bottom pattern. We had this confirmation line right at the middle of that W. When we went through it, that confirmed the pattern, and we should have expected a move from 120, about $20 up to that 160, up to test that high we had all the way back in August. However, what happened? It didn't. It failed. It broke down below that confirmation line, and now you could almost make a case for a reverse flag. It is sitting on that 200-day EMA, but Autodesk not looking too good. FireEye was downgraded today by Morgan Stanley from an overweight to an equal weight. This one is forming major double top. I mean, it's coming off this very nice rally. We hit a high, came down, tested that 200-day EMA, back to make the second top. We sometimes call this an Adam and Eve top because you have a spiky one and then a more rounded one on the second one. And we're almost down there to test that confirmation line. I would expect to see it, fall below that confirmation line. And look at the size of this pattern. That's, let's see, $3.50. So you subtract that down and we have 1350. So it's basically telling us to look for it to test that February low. So FireEye, I mean, I guess that might be a possible short right now. Public storage in the REITs was actually downgraded, and you can tell that the market is right behind that. Jeffries moved it from a hold to an underperform, and you could see that drop yesterday. Actually, we got notice there was a problem in that rising bottoms trend line, and that rising trend was broken. And it did close below that 200-day EMA. So we should be looking for a further drop. You could again make a case here for a double top, Adam and Eve top, and we've confirmed it. If you want to look at that measurement, it's about $10. So you come down here, about $10, and gets us right around that zone here of support back in October. So that's where I would expect it to head. Look at that PMO sell signal. So anyway, wow, I've taken up way too much time on that. Let's go ahead and wrap this one up. Here are the upgrades, downgrades. A couple I didn't go over. Five Below was upgraded. Marvell Technology was upgraded. Tractor Supply Company was upgraded. And then, of course, the other downgrades, Intuit, Rio Tinto, and Coca-Cola. All right. Sorry, Bill. I took up some of your time. But I know you've got plenty to talk about, and we'll let you go into that 10 and 10 for sure.
All right. Thanks very much. Let me get screen switched over here. All right. So what we're going to do, everybody, we talk about the market when it gets a little bit crazy, and everybody starts talking about shorting and inverse ETFs and all of those sorts of counter actions that you can get in the market. So I thought I would just do a little bit of talking about shorts and how to scan for them. We'll talk about some tracking ideas about how to try to find behaviors that will be setups for shorting. We'll look at the setups, and we'll go over what the actual shorting is. I mean, what really happens is a lot of talk about it, but it's interesting to know the mechanics of it, because that will also sort of give you some ideas for what can possibly go wrong when you go start shorting. So we'll kind of jump into it first. So what is shorting? So everybody talks about making money when the market goes down. So what shorting is if you've got a stock that's, say, at $20 a share, and you think it's going to have some problems and it's likely to go down, and you want to make some money off that, when you open your trade, you essentially have borrowed, let's say it's 1,000 shares at $20. We're going to borrow 1,000 shares from our brokerage, and we're going to basically go out and we sell that on the open market, and we now have $20,000. Of course, once we borrowed it, we're going to have to pay it back. The idea is that as the stock continues to go down, 17, 15, wherever, eventually we're going to say, okay, we've made enough money. I'm going to go out and close my position. I basically go out and I buy shares on the open market at 15, and I replace them. I return them, give them back to the original owner, and I've sold at 20,000 and I've bought at 15, so I've made $5,000. So I've basically made the money of that depreciation over that amount of time. And so that's the basics of shorting. And you hear other things like short interest as to how many of the shares that are out there are actually borrowed and shorted. I mean, you'll still have certain companies like Tesla, where you hear about the short interest being very high. These are typically companies where there's a larger expectation that something's eventually going to go wrong, and it's going to go really wrong, and the price is really going to drop. So you hear certain hedge funds will always be talking about companies like Herbalife and some of these sorts of companies where they think there's some something really kind of fishy maybe going on, or that the demand is going to fall apart and they want to try and make money by watching it drop. So that's sort of the theory behind shorting. And so what we're going to do is come up with a few ways with the scan engine to try and find some of these setups. And we'll look at a few different, like I say, behavioral patterns that we want to try and spot and take advantage of. So I've got my scan here. Actually, I want to go up to the user interface here. We're going to get short. And so what I've got here is a scan that's got sort of a base at the top. So I'm going to basically be looking for stocks that have about 200,000 shares a day. So I want to get something with a lot of volume, because you want something that's fairly liquid, because if you have to get in and out quick, you don't want the thing moving on you. We're going to go for stocks over $10. I'm going to limit it to the US. And within the scan engine, ETFs are sort of considered stocks. They trade daily, they have volume, so they behave like stocks. So, but I'm not looking to try and short an ETF, because that's a much broader thing. It would have less action, less it's more diversified, so it won't have as big a swing. So I'm going to look at avoiding the ETFs. From there, I've just got, let's pull this out a bit. I've got just a number of different ways of things to look for. So I've got a Wyckoff washout, relatively awful, 0 for 7, going down, Bollinger breakdown, and percentage peril. And when I was writing these, I felt like I was announcing like Jeopardy channels or something. So we're going to go through each of these, and each of them has their own sort of properties. So I'm going to uncomment these guys, and we're going to go ahead and let's scoot this back up, check our syntax, run our scan. So Wyckoff, for those who aren't aware of it, if you're interested in Wyckoff theory, Bruce Fraser has a blog, and he's an expert. He teaches this at Golden State University. The theory of Wyckoff is that initially there's some capitulation selling. Tom had this the shares earlier, the tailored, and that had a bad earnings report, and it gapped down hugely. And that's sort of the beginning of a Wyckoff process. And the Wyckoff can take quite a while to run through its process. But it's that initial gap down that may give us some ideas. And of course, here we found it. We've got the exact stock that Tom was talking about. You see this huge gap down on massive volume. So that's a first place to start of look, because you've got the initial reaction, and very frequently it's not going to be the end of it. It's probably not going to bounce back up to 20 tomorrow. So this is a way to start to find things that have this pattern of massive selling, usually on an earnings release or an update to earnings on expectations. Sometimes if you're looking at like a pharmaceutical that misses an FDA trial, some big news that affects the stock, you'll get this sort of action. So that's one of the setups we can look for. What will typically happen on one of those is we may see this initial drop, and we may see a little bit of a recovery, sort of a dead cat bounce, as it were. You may see, maybe we'll get a little bit of volume on the upside tomorrow. But if we see that thing break down again on, say, in this case, below down about 14, if we see it break there, then we can maybe have an expectation that, we're not done. We're going to be on a slide. So this is a stock you may want to put into a chart list as potential shorts. I mean, we may not want to go short things right off the bat here. We may want to kind of watch and see if they develop. And we may want to watch this and see if we get a little bit of up action, and then wait again for a down action below this, whatever low we put in today. So that's sort of using the Wyckoff approach of finding a large gap down. I'll turn this guy off, and we'll move down to the next one. On the upside, we're often talking about, and I know Tom talks about this a lot, relative performance relative to the S&P, relative to the industry, relative to the sector. On the upside, you want to see something that's outperforming its brethren, its brothers and sisters. You want the best of the best. So what we're going to do here is we're going to just flip everything over. And what we're going to try and do is we want to find something that over the last 20 days, which is about a month, and of course, this beauty of the scan engine, you can tweak that number to anything you like. We're going to find something that's worse than the S&P. It's worse than its own sector. So like the XLF or the XLI, industrials or financials. And we're going to find something worse than its own industry. So maybe insurance or banks or mining or whatever. So we're going to run that. We're going to get a lot more of them there because that means there's a lot of stuff out there that's underperforming the S&P. And so we probably on something this big, we've got 800 results. We probably want to put a few more caveats in here because personally, I don't have time to sift through 800 of these things. But you can see this one actually doesn't look too bad. But if you scan through some of these and make your way through them, we will begin to find a lot of these that are dropping off. Like here we had our Wyckoff scenario. Maybe we had some bad news. Volume wasn't super huge compared to this day. We had a nice gap, and we just haven't stopped. And so that's what we're looking for is relative underperformance. Now, one other area we can do, I'll just go over here real quick, is to use another feature that we talk about, and that's the sector summary. What we can do with sector summary, we're talking again about relative performance, and we typically use this on an upside. So we can set the sector summary to say a 3-month. Normally what we would do is we'd look for the best of the best, and we'd click the top row and we'd find the best of the best. We can do the inverse here. This is sort of what we're doing with that scan. We're going to go down and look at energy's not been doing well. Oil services has been doing the worst in that group. And then we can go down and we can look at who's in the basement of the oil services. So we can go scroll here. And this is where we're finding some potential shorts because these are really the worst of the worst. I mean, 98%. Okay, that's if you shorted that, you were probably looking pretty happy. But this is another way you can use the user interface and not the scan engine, try and at least find sectors and industries that might be exceptionally weak. So we'll go back there. I'll cover that guy up. We'll go down to our next one. This is a relatively new feature that we put in called Streak Down, and it basically says, I'm looking for stocks that have consecutive numbers of down days, or in this case, we're looking at the close. And so what we're going to look for here is stocks that have been down every day for at least 7 days. So they're just on us, just straight down. And again, we can change that number. We can, if we want something that's maybe not, if we maybe make that number too big, we might have missed it. If we find something that's been down 10 or 12 days, well, maybe we've got most of that downward action. So maybe we can find something that's down only 3 or 4 days and then again, put it into a chart list and continue to monitor it. But that's another excellent way to find stocks that are just getting no love at all. Another downtrend. Another thing with the scan engine we can do with the results sometimes is to sort by the sectors and industries, and sometimes that'll give us another interesting clue. It's like we may find areas that are particularly prevalent within this. We can say, well, maybe we've got a lot of industrial presence and a lot of financial presence and consumer discretionary of stocks that have been going down for days and days at a time. It just gives us another idea of where in the market can we look for weakness. And like Tom was talking about, the banks have been getting hit. And we've got, again, some extra evidence showing us that a lot of the financial distress is happening in the financial industry. Okay. Another idea very similar to this is, like, sometimes we'll get a break. We'll get that 300, 400 point up day as just a relief rally. And then, as in what we've seen recently, sadly, it doesn't last. So if we have a streak, we may have 4 or 5 days in a row, and then we have a up day where it even just goes up a penny and it ruins the streak, and then it goes back down. It wouldn't get caught by our streak, but we can do count up, count down. And that says over the last 20 days, how many times has the close gone down? What we're looking for here is say, I want to find something over the last 20 days, it's gone down 14 times. So that's basically what 75% of the last month these things have been dropping. Again, here we have a very similar sort of a Wyckoff drop. But look, you can look at this action as it led up to it. It was basically down for most of a month. And so again, the count up, count down, when we're using the count down, we can change that number. And we can, as we change this, of course, we're going to get fewer and fewer numbers, but we can get worse and worse as we go. See how far we can go before we start to run out. 16 or so. I mean, there's your, if you're a short person, that's a perfect sort of pattern to see. I mean, we've got moving average crosses, we've broken support, we've got massive volume all the way down, and we've just gone straight down. We had one little relief day, got a little bit of a relief day today, but that's just ugly. But if you're looking to short, if you short at 13 or so and you're down 11, you've made, 10, 15% in the space of a couple of weeks. Okay, we're going to go down to our next one.
Hey, Bill.
Yes.
When you, when you're looking at the market and you start to see breakdowns in the market, you feel like shorting is the way to go. Do you short individual stocks? Do you trade inverse ETFs? And I know we've got a poll running, and I encourage everybody to answer that so we can, discuss that in a little bit. But what's your strategy when you're feeling bearish and you believe that there's a better chance the market's going to go lower?
I tend to just sort of take some of my riskier stuff off the table, raise a little cash. I haven't done a lot of individual shorting. I've tried doing the inverse ETFs, but one of the things I've found with the inverse ETFs is, well, first of all, they diverge from the index they track over time. So they are a very short-term mechanism. You don't want to hold the inverse, NASDAQ for 3 or 4 months. It's just not going to match the performance. But the other thing I found trading those is that very often what you'd like to see is a nice sort of U-shape or a J-shape action where you get a nice downward and it kind of slows and it kind of goes sideways and it slowly inches up and you go, okay, I'm just going to leisurely take my profit. Mm-hmm. I found it's very V-shaped. It often comes down, it hits something, and it bounces very quickly. And if you didn't get in or out that day, you've sort of lost your window. And so I've played with that for a while, and I've just kind of determined I'm not very good at it.
That's actually a good point, because there are some people, I agree with you. I struggle on the short side because I can stick with a position and kind of be sane on the long side. But the short side, if you're shorting and the market starts going against you, I don't know about you, but for me, it's very emotional. And
yeah, go ahead.
I was just going to say, and I'll get out pretty quickly, and then, of course, it goes right back down again. But I tend to have a very, very quick trigger finger. I mean, I have a quick trigger finger anyway, but especially when I'm shorting. I don't know if that's a problem that you have as well.
I've got a little section at the end that I've some just observations, and that's one of them. And this is sort of a dangerous thing, and I'll go over a little bit of some of the dangers just in a bit here.
All right. Well, thanks for
sure.
letting me ask that question. I'm sure some others were probably sitting there wondering the same thing. How you?
Sure. If you or Erin have questions in the middle, fire away.
Sounds good.
All right. So this next one is, I'm just going to look at the Bollinger, but this can be sort of extended to any sort of channel. Bollinger is probably the most popular, but this could work with Keltner channels, which uses true range, and it could be with price channels or moving average envelopes. It's the just idea that there's some sort of a channel, and we've basically broken through the bottom of it. So we're going to run that. And I'll talk about another little minor feature that some people may or may not know of. I mean, most of the time we hit this little link here to go to our Sharp chart. This link next to it, a number of the scan indicators, we can determine that we have the ability to determine your scan that you've used, particular ones like Bollinger, some of the more popular ones. And we can create a chart with those indicators on it because that's what you're looking at. So maybe your default chart style doesn't have a Bollinger Band on it, but since you're scanning for a Bollinger Band, it'd be nice to see the chart. So sometimes if you click this and it's one of the indicators that we can recognize and put onto a chart, you can click that and we'll give you the Bollinger Band so you can actually get more of a visual of what you just scanned for. So I'm seeing here, we've broken down through the bottom Bollinger. So that's a nice little feature to try. And again, this is another way to finding something that's been relatively underperforming. That's what happens if we do our regular Sharp chart. But this is again that Wyckoff scenario. We've had the massive selling, huge drop, and then we've sort of continued to inch down. Maybe we're having a little bit of a leveling here, but it still got a pretty good setup for a short. All right, and I think the last one here I've got is a percentage, and this is just a pure, how much has this thing gone down over a certain window? I'm just looking for anything over the last 10 days that's gone down more than 10%. And again, another sort of clue is you can see how many results do you get. It's like, wow, 10% in just the 2 weeks. And there's 400 of just some of the US stocks. So again, we can see a pretty significant drop over the last 2 weeks. You know, so we've gone from 32, 33 down to 28 in the space of, you know, a couple of weeks. We had some relatively high volume. And these scans are just sort of an introductory, just some ideas. You can always put additional parameters in. You can look for volume that's much larger than average, like we did with the Wyckoff scan. You can sort of combine some of these. Of course, the more you add, the more selective the scan gets. At some point, you're eventually going to run out of things. So you kind of, it's a little bit of a art to find the sweet point of what sorts of criteria you want to put in, but still get results out of it. We could also look at other indicators such as RSI and stochastics, chandelier exits. There no shortage of the ADX trends. There's no shortage of ways to start to find shorts, but I just thought I would throw out some of the ones that I found would be what I think would be useful in looking at the patterns. And what we can do, let's go ahead and go back to our scan results here. And so this is just sort of the initial setup. And like I say, you probably don't want to just run right out of the scan engine and short something immediately. So what we would probably do is say, okay, let's store these guys. Got 400 of those. It's going to take a little bit to load. So now we've got a list. We can look at this in our other views. We can look at seasonality. We can say, well, maybe this thing is really bad in the fourth quarter. So that's a plus for shorting. We can look at our RGs. We can look at all sorts of our normal favorite tools. But the other thing we can do is once we have this, we go back here, and I'll just refresh this, is that we can create a scan. Let's just do a new one here. Let's see here. Just reset. And we can now come down and we can scan our list that we've already got. So I know this is something that both Erin and Tom will do. You'll take a group that's passed one set of criteria, and now you can run subsequent scans on it. So we were talking about, well, the Wyckoff setup, it's dropped, but we don't want to necessarily bite yet. So maybe we take all of these are our losers. These are the worst of the worst. And we can write another scan that says, okay, now take those and show me anything that's got a further 5% drop or has dropped, you know, another moving average or any of our other technical indicators. Those scan results are sort of like our second tier. Those are the ones that are saying, okay, I thought it was looking bad and I'm right. So that group, when you scan that group, that may be the group you want to start to say, okay, this is really where I'm ready to put my money in and start to make a move. So using a secondary list and putting a sort of a second factor into it will help weed out some of the ones that may not work. And you've just increased the probability, as Gaddis would say, Gaddis Rose. And now you found a list that's a little bit better chance of going where you want. And on the cautionary side, as Tom said, now what you've done here, remember, is you've borrowed shares and you've borrowed them at our fictitious $20 a share and you want them to go to 15 or 0. I mean, your best case is the thing goes out of business and you don't have to pay anybody back. That's pretty rare, but in 2008 it happened. So when you were in 2008 and you owned Enron or Lehman Brothers or Washington Mutual or something, if you owned 1,000 shares at $20, your maximum loss risk is $20 or $20 a share. It goes to 0. Can't go any lower to 0. It's not going to start digging. Not true when you short. You've bought something at $20 a share. You have to pay it back. If that thing starts to go up, you're losing money, and there's no limit to how high it can go. So what you've heard of the term of a short squeeze, or knowing the short interest, in other words, how many people are shorting this. What happens is, if something comes out, a good earnings report or an upgrade, downgrade, something happens that causes people to start buying the shares. Now you're trying to cover your shares. You say, I better go buy my shares back and replace them. I'm starting to lose money. The stock's going up. The more people have shorted, now you've created more demand. So that stock starts to go and rise. Other institutions and other individuals may say, hey, this is starting to rise, so I'm going to now buy. That puts more pressure on. That causes more shorts to get knocked off the fence. And it sort of can form a vicious feedback loop. And that can cause a huge, huge spike. And that's what you hear about talking about a short squeeze or short play. And probably the most notable one was about 10 years ago. And I'm probably a little rusty on the details, but essentially Volkswagen became the most valuable company in the world. It's 2008. You're looking at a company that has massive overhead, huge debts and infrastructure. If they're like the US, the automakers have huge pension obligations. And it's 2008. You're selling a product that no one wants to buy when they have no money. So Volkswagen was shorted, I think 15% of the shares were floated, of the float were shorted. And the average was, I think, 5%. And then, sort of out of nowhere, Porsche announced that over time it had accumulated 75% of the voting rights of Volkswagen. The thing skyrockets. And in the space of a day or two, I believe it tripled in cost. In the shares of Volkswagen went up by 300%. All of those short owners, 15% of the population of Volkswagen, were suddenly selling or buying to cover their shorts. That again pushed it up, and that spiked Volkswagen to be the most valuable company in the world very quickly. And people lost millions and millions of dollars, because going back to our example, you borrowed at $20 and you're going to pay it back, but suddenly the stock is at $60 and now you're down $40,000. And this was overnight. And some of those were people playing with a lot more than just 1,000 shares. So this can be extremely dangerous. So if you are shorting, I would say ease into it, short very small amounts. And from the stock chart side, I would have price alerts. You really want to be on top of this, because if it goes the wrong way, a lot of people want to short things like pharmaceuticals, expecting a drug trial to fail. If that drug trial doesn't fail, you could be ruined. So, and it may come out of nowhere. So this can be very dangerous. Sometimes it's better let the ETF funds do it. It'll be a little bit more diversified. Shorting individual stocks can be very dangerous. So that's sort of the word of caution on shorting.
Yeah. Also, Bill, when you're shorting, and I don't know all the dynamics when you talk about the different brokerages. I mean, sometimes you could try to short a stock with Schwab and they'll allow you to short it. You try to short the same stock with TD Ameritrade and they'll tell you that they don't have any shares available. So it's not like, you can do this everywhere. Some stocks are shortable, some stocks aren't.
Right.
A lot of things that, can be kind of frustrating too when you go to short. And think about this. I mean, I'm going to put this in a really simple explanation, but let's say that there's a brokerage out there and you want to short 100 share, or let's say 1,000 shares of Intel, and they have 1,000 shares available to be shorted. You don't have to go contact the other owner and say, I want to borrow your shares. I mean, it's all handled at the brokerage account. So anybody who's new to shorting and wondering how this is all handled, the brokerage will either allow you to short or they won't. And sometimes it'll just come out up and say, there are no shares available. Right. But let's say there's 1,000 shares available. You go in, you want to short 1,000 shares of Intel, and now Intel, you've borrowed their shares and you sell them short. So now you're waiting for the stock to decline and then profit from it. Now, let's say Intel was trading at, $48 at the time. And now let's say the stock's gone up to say 52, and the person whose shares you just shorted put an order in to sell their shares for $52. Well, now all of a sudden the brokerage needs those shares back that you borrowed.
Right.
And so they can force you. It has happened before to me, where a brokerage has said they basically have the right to force you to cover your position at some point when you don't want to, because they need those shares back. So that's part of a risk of shorting as well. And I know that's kind of a simple explanation, but and there are ways to protect your shares too from allowing others to borrow them to short. For instance, if you put in limit orders for your stock, if you're like, hey, I don't want anybody shorting my stock. I don't want anybody taking the price of my companies lower. I own them. So you could, and I don't know all the rules. It's been a long time since I've really looked into it, but I believe if you put an order in with your broker, a limit order that's reasonable, somewhere near the current price, I don't believe they can allow those shares to be shorted. So there are some other things that go into shorting as well.
Yes, just the general discussion should also sort of raise a little red flag that it's a little bit more complicated than it looks, and it can be a little bit dangerous. And so, yes, you can get called like that, and that's another reason to try and find a fairly liquid stock. The probability of something like that happening on something that's thinly traded would be higher. And of course, thinly traded, you'd have wild moves, which could go in your favor or go against you. But if it goes against you, it could go very badly. It could be a Darwin Award winner pretty quick.
Yep. Yeah, that gets scary.
Yeah. So I'm curious to see what our poll had. I was talking to our producer, and we were going to see what people did when a bear market comes. What's their strategy?
I hibernate.
Yeah.
Looks like you're there.
Yeah.
Yeah. I mean, I look at it. That's not too surprising to me. I think those top two, I would say, is what I would prefer to do. I mean, I tend to move to cash, and then I'm not going to say it's not risky, but I think it's less risky to buy an inverse ETF than it is to go out and begin shorting individual stocks.
Yes, absolutely.
Well, it's like, a lot of people buy ETFs, for the upside as well, just to protect themselves from those volatile moves of a single stock. So makes sense.
Yeah. And Bill, you made a great point earlier about the erosion that takes place between some of these juiced or leveraged ETFs and the underlying index that they're supposed to track. They do a great job tracking in the short term, but I think I even mentioned to you when I was out in Seattle, I had done a study of the bank index, and I think it was the SKF, which was the double inverse ETF that tracked the banking group.
Right. And
during that whole collapse of banks back in, I think I did it from like September 2008 to maybe March of 2009, the banks got absolutely clobbered to the downside. So, you're thinking, wow, if I had that juiced inverse ETF on the banking group, I would have made a fortune. But when I went back and looked at it, the inverse ETF, I think it went down like 5%. The juiced inverse ETF, the group went down 30 or 40%. So you would think, oh, I'm in double, I should make 60 or 80%. It wasn't anything like that. In fact, it was incredibly disappointing. And it's all of that volatility back and forth where you have erosion in some of those juiced ETFs. So understand what you're buying. Make sure you understand what you're buying.
I did the same thing when Gaddis Rose taught classes here, and I helped out a number of years ago, about 10 years ago, and I was doing the same sort of thing. They were just starting to become popular, and I was just like, well, let's just kind of see how this works. And I had a spreadsheet I kept, and I did that exact same thing because I started to notice, because I went in thinking, well, it's just going to track double. I mean, that's what it's supposed to be, right? 2.0x.
Yeah.
And so after a while, I was like, this isn't working. And I put spreadsheets together, and I started tracking it. And it's like, okay. There's a fundamental failure of assumptions here.
Right.
and so, yes, it's sometimes not exactly what it appears.
Yep.
Yeah, I've been a fan of those before, and I've actually traded them occasionally, not too often, but I will trade them if I feel really bullish about a group. Maybe it's just breaking out, or maybe it's come down, the underlying index has come down to a major support level, and I'm like, okay, if it's going to go from here. So I'll jump into a juiced ETF, and if the index breaks down, I can get out pretty quickly. But I look for a bounce. And if I get that for, 3-4 days or something, and even if it shows one little sign that it's rolling over, I'm out.
Yeah.
No chance. It should be, I think those are designed. And initially they didn't give you too many warnings back when they first, there were a lot of brokerages getting in trouble because public really didn't understand them that well. And now when you try to buy them, they pretty much have you sign on the bottom line that, hey, I understand all of these things can happen, and I still want to buy it. kind
It
of.
is really a trading vehicle, and it's designed for a trader as opposed to a buy and hold long-term investor. It's definitely a trading vehicle.
Mm-hmm.
Right. Short term.
Yes.
Yeah, and that's yeah, I've bought them before, just to hedge, on, a correction or something like that. But I don't have time to follow everything that closely, which, like I
Exactly.
said, is why I'm an intermediate term trader. Uh, but
I'm
I've used those as a hedge. I think they're not bad.
Yeah, I'm with you, Erin, on that. I don't have the time to look. And like I say, a lot of my experiences, these things, they do a V bounce. I mean, it goes down and then it just pops straight back up. And it's like, well, I got out and maybe I made a little bit, but maybe I lost. But in the end, it certainly wasn't worth all the effort.
Exactly.
That's the only takeaway I got from it.
Hey, Bill, there was one question before you go in the
Sure.
room. I'm not quite sure what was meant by it, but the question was, what are some caveats of the percentage relative functionality? So is there anything out there, using percentage relative? Are you aware of any, caveats, warnings, or anything that people should know before you?
Well, I would say I usually use the percent relative with closing prices. You can actually put indicators in there. You can do percent relative of RSIs and whatnot. So if you get some of those numbers are not necessary. I mean, they can go negative, they can go near zero. Percentages of numbers near zero can get very big.
Yeah.
So they kind of don't mean anything. And another thing you can do is, like, remember what you're trying to do. I would say, like, is it really telling me something if the percentage of the fall of the RSI of the S&P relative to Apple? I mean, is that really telling me anything?
Yeah.
I mean, first of all, it's relative to itself. So you kind of want to pick an indicator that's sort of, apples to apples. And that's why you always use closing price. Basically, I just want to see what's the price action from one thing to another. So although it will take indicators, I really haven't found a really good use for that.
Okay. Yeah, I've written scans before, and I've gotten them returned, and then I've looked at the stocks in the scan, and I'm like, now wait a minute, what am I looking for here? Because I have so many different things in the scan, and I'm not even sure that they make sense by the time I'm done.
Well, and that was I have to give you a little homework, Bill, because everybody wants the scan language of
Okay.
scans you showed. So I'll need those for the recap.
Oh, okay. Yes. Yeah, I'll put those out there. And what I can also do here real quick is I'll see if I can stretch this out, and then people can look at the recording and or freeze the frame here and take some
Are
notes.
you showing your screen? Because you need to grab the screen if you are.
Okay. Yep. Hold on. Good point. I'm just in my own little world here.
That's all right.
We do it all the time, and we do this every
Every
morning.
Yeah, you have an excuse, Bill. We don't.
All right. So can everybody see that?
Yes.
Okay. I've got the little hashtags there at the beginning, basically comment out the line so I can basically turn things on, turn them off. And like I say, all of those, you can change those numbers, dial them up, dial them down. If you get 400 results and you want 25, change the numbers, see where you go.
Yeah, I found that's one of the most useful things of the scan sometimes, is just kind of playing around with it to get something to fit, what you're looking for.
Right.
Excellent.
Right. Thanks so much, guys. And everybody have happy, safe holidays out there. I'll probably talk to you in the new year.
Yep.
Yes.
You, Bill. Thanks for coming by.
Cheers.
All right. There he goes.
Yes.
I love having Bill on because he always has great scans, and I can never get him looking like he does.
Oh, I know. Exactly. No, he's my scan hero.
Yeah, he's the master for sure. All right. Well, we got to get rolling here because we got a lot to cover. So you want me just to do the first one, or?
Yeah, let me, well, I'm just going to grab it really quick just to show the sectors. A lot of ETFs right now, and pretty healthy mix of the different sectors. No industrials, so that was interesting. So, and I will just pass it back right away to go for you.
All
Greg
right.
Snell saw it in the room and said, "I wish this market would go."
Yeah. I don't know. I have my doubts right now, but we'll see. I mean, last time I checked, I haven't looked in a while, but I think we're still above the 2582 level, so we should be fine for now. Anyway, go, big sell-off here with heavy volume. That was a secondary offering or some kind of a note offering. I'm not exactly sure what it was. I just know that they came out after hours. Stock looked really good technically, and then all of a sudden, because of the potential dilution, the stock got hit pretty hard. Many small companies, sometimes when they're in uptrends, they want to raise money when the price is higher. So it's not unusual to see this kind of behavior. But unfortunately, this really took the wind out of the sails of the bulls here on GoGo. Here we got the gap down, big move down. There's your price support. We bounced up. We came back down, tested it again, smaller bounce, and then the breakdown. So looking across here, it seems to me like this 405 to about 420 area has provided some pretty good support and resistance. And you can see recently, last couple of days, as we get up over $4, seems like that's where the sellers have been sitting. So I want to get through this area of resistance and especially get back up above that 20-day. I think the stock could begin to gather itself once it does that. But until it does, I would avoid it. I would not be jumping in here.
All righty. And the most popular request in the chat room is Amazon.
All right, Amazon, great company. We don't have to talk about all the fundamentals here, but I'm kind of watching a little bit of a symmetrical triangle off of its last uptrend. So let me just kind of show you here. Here you can see the lower highs coming down, and then as you come across here, kind of got these higher lows off of an uptrend, which normally I would say, you want to think about breaking out, but the overall trend is more of a downtrend since the October high. So I think probably I would be keeping an eye on the double top that just came in right here at about 1780. Until we get through that level, I think the overall long-term or intermediate-term downtrend could continue to be in play. And to the downside, if we lose the area down closer to 1600, I think we're going to be in trouble. So short term, it's getting a little skittish here. I'm turning a little bit more bearish the market. I'm sitting in cash. I would not be jumping into Amazon here.
All right. And the other one that was quite popular today was PFE, Pfizer.
All right, Pfizer, I do like. Pfizer, well, it's just in the pharmas. I like that space. Pharmas are a little bit more defensive. They're still holding up well technically. I think we could probably just draw the recent high, recent low. I think as long as we trade in this range, 41.5 up to 46.5, I think Pfizer's fine. Obviously, the lower end, you've got a much better reward to risk on a long trade. But I think that the uptrend is still in play here. We're sideways consolidating. This is one of the areas of the market I think still looks pretty good.
All righty. Next one, Netties, NTES.
Wow, this is one. This was actually my setup from this week. It was on the short side, and the two key areas that I was looking at, and I'm actually watching this one pretty closely today, because if it fails to hold this breakout at the close, if the market rolls over and I get this long tail up above this gap resistance and it comes back down, it potentially could be my first short. I'm actually thinking about shorting the stock, but I wouldn't do it here. If you did it earlier in the week, I think I talked about two areas. The bottom, I don't know where it was, around 240 or 238 or something like that from earlier in the week. And then the second entry was, short entry was like 251. So if you did that, you'd be in somewhere around 245 on average. I think if it closes over the 252, 253 area, I would probably not take any chances. I don't like taking big chances, especially on shorts. But if it does reverse and comes back down, you're looking for entry. I think a move back down below 251 would really start to look interesting, leaving a long tail above that gap resistance and then coming back down, because there was a lot of volume, a lot of sellers from this level. So if you get a reversing candle here, that could be a pretty good short-term signal, but we'll see how we close today.
Okay, sounds good. Next one up for our Canadian friends, KL.TO, and that's Kirkland Lake Gold.
All right. Yeah, gold stocks, this one looks good. And I think we've talked about this one in the past, not very often, but I just kind of remember the chart and the name. But there was your breakout, pretty significant breakout. You can see the volume was pretty high as you made the breakout through 30.5. We're very overbought. I would not jump in at the current price. But if you like the company, like the stock, I think a pullback back to this double top breakout area would be very interesting, especially as the 20-day continues to rise and gets close to that level. The other thing I find interesting about the market is, I didn't look at the dollar today yet, since earlier pre-market, but the dollar has been pretty strong, trying to make a breakout, and gold has held up pretty well here of late. I don't think that'll continue for the long term, but short term, it has been the case.
All right, let's see. Next one up is, man, Bill left. This would have been good. Boston Beer. Sam.
All right. Oh, I love the candle today. I like this coming down to the bottom, testing the bottom, and then rallying. So I wish I'd have caught it a little bit earlier today, because that's a lot of times my strategy when I like a stock and it's getting close to support. I like to see it go below the prior lows intraday, which this one did just barely, because anybody from a technical perspective, when you see that breakdown, you would be a seller. I would certainly be a seller. So the only reason you get these reversals is market makers building inventory. So when I get the reversal at support, I tend to like it. Now, to the upside, I don't know that it would be a great trade from the current price, because setting up reward to risk, to the upside, you can get up maybe to about 280, although the 20-day will continue to drop. That would give you $15. You can leave probably about 5 or 6 to the downside. So it is almost 3 to 1. Obviously better closer to the 260 area, but I like the reversal so far today on Sam.
Okay. Next one, I'm out of it, but natural gas, UNG. I was in there and I got to ride that flagpole, and so I got out.
Yeah, and I think, wasn't this the one that had a resistance area that was right at about the top? Maybe it was a weekly chart that I used.
Yes.
I remember we talked about it. And
it did. It hit like right on it. Yep.
There it is. Yep. So this is why I follow candlesticks. I mean, when you look at this, we had a breakout. Again, this was intra-week, but even if I took the top of these prior weeks, you can see we went above that. So we were setting new highs, and then we came back down and failed to hold it. And when we did that, I would be out. So I think being out is the right place right now. I wouldn't be surprised to see maybe a move all the way back down to test this rising 20-week moving average. So that would be another 10% lower from where it is now. For now, I think it's just in this trading range, 20-day to the downside, and then that resistance in the 39.40 area to the top side.
All righty. Yeah, I think you could still make a case for a flag there, but if you lose that support, that real short-term support, forget it. All right, next one up, IRDM, Iridium Communications.
Double top, false breakout. I mean, well, it wasn't a bearish engulfing candle because we had a little bit of a gap down. But check out where we were prior. That establishes your resistance. Came back up, a little bit of a, well, that's a hanging man, which is a bearish candle. But then the next day we went up even higher and reversed down. That's usually not a good sign. Now, short term, we're holding the 50-day moving average. I don't know, we should have a little bit of support there, but this is your big one way down here, because here's your high, here's your reaction low, here's a slightly higher high. You don't want to lose this low, but you're well above that right now. I don't see a trade here. That's my biggest problem. I like the uptrend. We haven't broken down. I got some bullish feelings here, but I just don't know. If I got in, I probably would use maybe 21 as a closing stop, or maybe just below the 50-day moving average, looking for maybe another test up there around the 24 level. We could see this uptrend followed by a cup. So we could get a rounding bottom and a move back up to test that area. But again, we're talking about, you know, this being more of a bullish type of a setup, and I'm not sure the market, especially if the S&P 500 loses support, I'm not going to be overly excited about that.
All right. The next one up, let's see, Ring, RNG.
I think this is in the software space, I believe.
Mm-hmm.
Look at the false breakout yesterday. If I had to do anything on this stock right now, it would be on the short side. And I like software. I think software is still hanging in pretty well. But there is basically your prior highs, double top. Look at that candle. We had a breakout intraday and we came back down, reversed it. Now we got a bearish engulfing candle today. Volume trends are still okay. And the rising 20 days holding. Again, if I had to do anything, I'd be short. But I would probably cover if I hit the rising 20-day moving average, because the overall momentum here looks pretty good.
All right, and our last one, AstraZeneca, AZN.
All right. I looked at this one when I was trying to put together some stocks for the last segment under the radar. This is one that's just kind of backed off a little bit from its recent high, but the overall uptrend is in play, and it's in a good space. It's in that pharma space. So if we pull up, I'll do this one on a relative chart, last one. But if we're looking at it on a relative space, first of all, check out the pharmas. Pharmas have been doing extremely well. This stock has kind of held its own relative. It was in an uptrend, then in a downtrend. Now it's kind of just sideways, but it's going along for the ride, and the ride has been a pretty good one. And you've got the stock outperforming the S&P because it is in a good group, and you've got pharmas wildly outperforming the S&P 500 right now. So I could argue that this is a stock that's just kind of under the radar. I mean, it's pulled back. It's just kind of not doing a whole lot, but it's in a great group. I suspect we'll probably get a breakout. And what I would look for here is a break of its recent downtrend line. So right here, I think when you connect these tops, I think if we get a breakout, maybe even take the intraday highs. But I think if you get a breakout above, say, 39 3/4, $40, I think that's going to lead to another test of 42 and probably another breakout. So I'm a fan of AZN, mostly because I do like the healthcare space. I think that will continue to perform well relative to the S&P 500.
Okay, and that does complete the 10 in 10. And here are the symbols that we just went over. And I will have those up in the Market Watchers Live blog recap. So just go over there to the blogs tab, Market Watchers Live blog, and the link to the chart list is right there at the top. And of course, it's always in every recap that we put up there. All right, time for our final market update. So let's see what has been going on since we last left. Let's see here. All right. Not so great. We were on the positive side to start out the day, but we have now moved into negative territory for most of the, most of the major indexes here. We were continuing a nice rising trend into yesterday, and as we all know, it kind of fell apart. And now we've been trending lower. The Dow's not too bad as it's consolidating, above yesterday's close. It has dipped down below right now. The S&P, however, has now got a very clear downward trend, as well as the NASDAQ. And look at the mid caps. When it started that downtrend later on yesterday, it's just been heading straight down at a very steep angle along with the Russell 2000. We don't want to see those small caps doing poorly if we want to see a bull market or a nice rally. Bad news there. Canadian markets kind of following suit here, down just slightly. The treasury yields are just down a little bit here to 2.904%. Volatility has been moving mostly sideways, but we're seem to be sticking right around that 21 range, currently at 21.26. UUP is up on the day, but only by 2 cents, 25.96. Gold, big gap down. Started to make a little bit of a recovery here. Took back, it looks like, about close to half of the losses. And it is trying to break above the overhead resistance that was formed earlier this morning. So I'll have to see if it can get itself back up into positive territory. USO made a move to the upside, and it is pulling back slightly. Where USO is reading almost at $11 at $10.99. TLT continuing its declining trend. Looked like we might be getting out of that. However, nope, it just continued lower. But it looks like we're having a pretty good, this is a 10-minute bar chart. So it looks like the last 10 minutes have been pretty good there on TLT. Maybe we're going to get further up to the upside. Now it's at 118.27. And that's all I have for my portion of the final market update. What do you have, Tom?
I just want to underscore the weakness, the relative weakness in the industrials and in the financials. Here's a chart of this, a 5-year daily chart of the XLI relative to the S&P 500. And you can see all the way up until about January, we were setting new highs. And this is what you want to see because industrials are more aggressive. You want to see money rotating into that area. But look what's happened throughout 2018. We are now at lows that we have not seen since back before the presidential election in 2016. So industrials on a relative basis completely fallen apart. Here's financials, the high again back in February. And look at what's been going on throughout 2018. And we're now at new lows again on both of these on a relative basis. So financials had broken out above this level at about 0.0093. And here we are right back down at this level. That's about the only positive I could say about these two charts. Money rotating out of two key aggressive areas throughout 2018. And this is why back in February, I was still bullish the market when we had that first major drop to the downside. The aggressive stocks were still fine. This paints a completely different story, and that's why I'm growing a little bit more bearish. So let's get to the last segment. We still probably have about, 9 or 10 minutes or so.
Yes.
What do you got?
All right. So what the under the radar segment, just so everybody knows, is we're looking at stocks that maybe have really heavy volume, stocks that maybe the market makers haven't really noticed. And I definitely have some obscure ones, but I think they look fairly good right now. And I'm looking at these on the bullish side, just so everybody understands where I'm at here. All right, let's make this bigger. All right, so I'm going to continue. I'll keep the full quote up here just so you can see where we're at on some of these and what they are doing currently. So as you can see, I went ahead and picked ABB Limited. I got the PMO buy signal, and we had, a fake out decline here. But look at the volume that's been coming in. A lot of interest on this stock. Had the island here, and we got the reversal, came in, above that previous low that we had. So we're making higher lows, and we're now above that 20-day EMA. So, I think this one could be traveling a little bit under the radar here. The only thing I have to say is that, overhead resistance is a little bit close here at about $21 or $20.75. So this one I probably want to have my hand on the wheel and watching it fairly closely. The next one I have for you is Cytom X Therapeutics. This one is very thinly traded, so just a quick little warning there that it's at 115,000 right now. But look at the volume pattern going on here. I thought this was really interesting to see all of the interest here on the way up, as well as back here. You can see when we started this whole thing, this rally. So I like the way we're getting that rounded bottom coming in here. You could make a case, really, I think, for a double bottom or a triple bottom sort of situation. Look for a move above that $17 range. You can see improvement in the scooter, improvement, like I said, in that on-balance volume. So I thought this one looked pretty good as well. Most of these that I'm showing you, though, again, you've got 50-day EMAs below 200-day EMAs, and we're in what I think is a bear market. So you need to be aware. And really, with most of these, I think you need your hand on the wheel because you're bucking the trend right now. The trend is down, and if you're trying to go in and get some buys, you just really have to keep a really close eye. All right, Imperial Brands was another one that came up. This is a consumer staple. And, this is where you kind of want to be in a defensive group. I thought this one looked pretty good. Look at the PMOs now turning up in oversold territory, improvement on volume. You can see that high volume on this rally to the upside. OBV, of course, that shoots it right up, and Scooter starting to make a nice improvement. So I like this setup, but I would just be warning that I could also, I think, make a case for a reverse flag. So again, just you got to keep an eye on these. But I think this one actually, Imperial Brands, looks pretty darn good. All right, PSK. Let's see, I've got them all in here. All right, and this one's a SPDR, Wells Fargo Preferred Stock ETF. And look at the interest here as far as volume goes. And I have the PMO turning up, not quite to that buy signal. Like I said, very interesting volume pattern going on here. Scooter, meh, not the greatest. And we do have this overhead resistance area at 40.25. So again, keep an eye on it if you do want to try and get into the buy side. Pivotal Software. This is, I think, yeah, pretty much a new stock that is out there. And you can see it's been trading wildly, and it's been in a trading range right now. We've got some interest here. We got some nice volume on it yesterday. I am getting a little bit of a top here on the PMO. But now, if you want to look at this as a trading range, we're kind of near the bottom of it right here at that $17. So that's something to consider. Also, I think you can make a case for a double bottom here coming off of this big decline. So, but you need to see that confirmation line at $21 broken. So if you're going to be riding it that long, I mean, the pattern I don't think is all that important. All right, PMO buy signal here on RA Pharmaceuticals. Again, a low volume stock, but really tons of interest you can see here. Nice rally, PMO's looking good, and the volume, of course, with those two big up days, OBV is going nicely to the right direction. And then I had a couple that I added just at the end that I'll put in really quickly, and then you get your time in here. All right, another biotech, again, another low, thinly traded, but I like these setups. You've got these rounded bottoms, possible double bottoms, lots of interest on the buy side. PMO's heading up. It's almost into positive territory. Nice move on OBV, nice move on the scooter. And then finally, the last one I had is NEOG. And this is in medical supplies. This one has been consolidating sideways, most definitely, but momentum is building on this sideways move. And so that tells me that there is a likely push that we'll see to the upside. And you had that really nice volume that came in yesterday and a couple days before, making the OBV move well above its previous top, scooter improving. I think this one looks pretty good, and it is in a good sector in healthcare. So this one might be one to consider as well. Got to get over that $65 resistance, though, and in my opinion, close above it. That's the ones I have. What do you got, Tom?
All right, I'm going to go through these kind of quick. Here's the relative chart of the XLV healthcare ETF relative to the S&P 500 since the turn of the century. And I want you to focus on what happens during bear markets. 2000 to 2002, look at the outperformance by healthcare. 2007 to 2009, again, the outperformance. Look what's going on right now as we wrap up 2018. Significant outperformance by healthcare. So under the radar, if I was going to be doing anything on the long side, I would really try to focus much more on the healthcare and some of the stocks that have been performing really well. Centene, CNC, here's a stock that had broken out, had a false breakout, reversing candle, and has pulled back. But I think this pullback, especially if we could get down close to 125, could present quite an opportunity. It is in the healthcare providers index, which has been going higher. Next up is Cigna, CI. CI is also a healthcare provider. And you can see, again, there's the move up in the group. And look at what happened on this stock recently. See how it came down to those prior lows, put in that long tail, false breakdown, and reversed back up. Now, it only went to the 20-day, and perhaps it's going to come back down. But that's the kind of maybe technical price behavior that I would be looking for out of these stocks. Get them when they're close to support, because this is a group that is still in favor in the market. But on a bounce, I would be willing to just take the profits and move on. Moving over to the pharmas, Abbott Labs, really strong stock. You can see tried to make a breakout here just a little over, well, maybe a little over a week ago, but pulled back, got close to recent support. I think this 66, 68 area pretty strong. Once again, you can see pharma's doing very well. And on a relative basis, pharma's just crazily outperforming the S&P 500. Just a couple more here. First, Varian Medical, which is VAR. This is in the medical equipment group. Now, medical equipment stocks have been downtrending a little bit, but if you look at their relative performance, they're not downtrending nearly as much as the S&P 500. So again, you've got a group that is seeing more than its fair share of money. And this is a stock. Look at this overhead resistance, 128 to 130. If it could ever break through that, that would be incredibly bullish. But in the meantime, on the gap up, we came back down. We held gap support. We broke out again, holding the 20-day moving average. Got another gap in here around 118 that's been holding. I think any kind of a pullback into the 118 to 114 area would represent great entry into this one. And then the last one I have is ResMed RMD. Came all the way back up. Here's a stock getting ready to break out or threatening to break out. Given what's going on in the market, I don't think there's any question this is a tremendous relative performer. This also is a medical equipment stock. So again, you're in a group that's pretty strong. Look at RMD relative to its peers. Look at RMD relative to the S&P. And then, of course, you've got medical equipment continuing to push up relative to the S&P. So I think, these types of stocks, even though we might not call them under the radar, I mean, I'm sure you've heard of some of them, but they are companies that I think with the market being so bearish, I think a lot of folks don't realize how bullish some of these charts remain. So, based on what I showed you in the history of those last two bear markets, if I was going to be long anything going forward in the next couple months, if we break down the S&P 500, it's probably going to be some of these stocks that I think present less risk as long as I can get them close to support. So there's your under the radar summary stocks that we just talked about. And I tell you, right now, Erin, looking at this market, not feeling very good. NASDAQ now down 52. Russell 2000 down almost 20 points today, 1.34%. So, you look at the Dow and you're only down 0.05%, 12 points. And you think, well, that's not much. Well, look at the Russell 2000, and the Russell 2000 is already breaking back now to the to the lows that we saw recently. So here you can see the Russell 2000 down almost 20 points. And if I pull this chart up, you'll see that where we were on the lows just a few days ago, we're almost back down there again. So the S&P 500 still got some room, but some other areas like the Russell 2000, of course, we showed the transports earlier. Look at this. I mean, this just does, it's hard to paint a bullish picture here.
It truly is. So, I mean, you know me, I've been bearish for for at least a couple of weeks, right?
Yeah, well, the momentum clearly has been to the downside. I don't think, it's difficult to argue against that, and especially if we pull up, like a weekly chart and we look at the weekly PPO or PMO or MACD or any of these. I mean, you can see what's going on here. I mean, you look back over the last couple of years, we've not seen anything like this.
No. And you're certainly not a perma bull, in my opinion. You've been looking at this as a pretty volatile correction, whether it's a bear market or not,
Well, to me, the difference, 2016 turned out to be a correction. It was pretty ugly. I mean, I can remember having some of these same feelings in the beginning of 2016, and then the market bottomed and simply went back up. And I know that there were many calls that was a bear market back in 2016. So for me, it's all about that price, the price support area. You can see on the NASDAQ 100 here, we're still, hanging above this level. And of course, the big one I was talking about earlier, the S&P 500, this moved down. Now, this is a weekly chart, but the dailies, we've never seen a close. We haven't seen a close below 25.82. So that's what I'd keep an eye on. All right. Well, that is going to wrap things up for today. I definitely want to give a big shout out to Bill Shelby. Thanks, Bill, for coming on. Always fun to have you on here talking about the scans. I know we have so many questions. Erin goes over a lot of the technical scans. I do a couple here from time to time, but Bill is truly the guy in terms of the scan engine. So it's always great to have him on here. Also, want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a reminder, it's located just below your video player. Love to hear what you think of the scan presentation today. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you back here tomorrow. Happy trading.